Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro at tastylive. And we have another interesting but quiet day in financial markets. Our week-long lull in big macro event risk continues. Nevertheless, quite a bit to talk about here, and we're going to tackle kind of a big one today. There's obviously a flurry of conversation out there about whether we've hit the point where we're going to have a soft landing for the economy as it digests all of the aggressive rate hikes that we've seen from the Fed and other central banks to tackle inflation. Things are going to be okay. Labor market in the U.S. is adding 500,000 jobs, more than twice the expected amount. Everything is great. We've even heard comments saying, you know what, we don't need to even have a landing. What's all this talk about recession? We're not even going to land. We're just going to power through. The economy will keep growing. So is it in fact all clear? Are we back to perfection, economically speaking? Are we in a world where everything is just going to be absolutely great and we are not going to have a down turn? We're not going to have a situation here where there's some sort of crisis because of tightening. Are we in a place where this is something that really the Fed can be as cheery as possible about, and investors too? Well, let's have a look. My sense is that we are going to find some interesting bits here for both sides of this debate. And we begin with global composite PMIs. Here we're going to look at the global overall number in the bars there, the yellow bars, and we are going to look at the three major economies that really power this thing. Together, these are overwhelmingly the drivers of global demand. By themselves, before we even get to the economies that depend on demand from these economies, we are in a environment where just the three of them by themselves account for over 50% of the global growth pie. So we have a situation here where this is really defining for the economy. And you can see here green shoots. So growth in China back above that magic 50 number in the logic of PMIs. PMIs give you a sense of whether manufacturing and services, this is the composite, so it includes both, whether those sectors are growing or shrinking. Above 50 means growth, below 50 means contraction. 50 is neutral. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And so here, we're looking at growth in China that's flipped back above 50. We're looking at growth in the Eurozone that's neutral, but certainly off the mat, having recovered from sub-50 levels. Still a bit weak in the U.S., but of course in the U.S. we've had the most rate hikes of any major economy. So not surprising that it's a little bit more restrictive there. And we do seem to be kind of cautiously coming off the bottom. The global numbers, those yellow bars that we're looking at here, just at the 50 mark. So we've essentially returned to growth that's not shrinking, economic activity that's returned to a sort of baseline, over the past 3 months of improvement. So there does seem to be a sense here that things are looking a bit better. But let's keep going. This is a look at GDP forecasts from a survey of economists and various professional market watchers by Bloomberg. The 2023 number there, the 2024 one, and then the yellow bars are the Citigroup Economic Surprise Index, the global one. What this is looking at is how economic data performs relative to median forecasts. So those same economists and market watchers that are polled for these GDP numbers by and large will give you the kind of forecast that you see when, for example, U.S. jobs data is expected to come out at XYZ number. That expectation comes from a polling of economists. What that yellow index there is doing is saying, what are the realized outcomes relative to those forecasts? How is data performing? Is it outperforming? Is it underperforming? And what does that say about the consensus market view as compared with reality? And what we're seeing here is fairly interesting as well. We can see growth forecasts have been pointing lower. Certainly 2023 looks like it's been steadily deteriorating all the way into the third quarter of next year, where it seems to have kind of found a floor. And for 2024, not a whole lot of change over the past year, but even there, drifting slightly lower and certainly not showing signs of meaningful improvement in recent months. Nevertheless, U.S. And global economic data increasingly surprising higher relative to forecasts. And the trend there starting to look quite emphatic. So not only do we continue to surprise higher, but we're doing so by a larger margin as those yellow bars go up. So again, seemingly a positive story. And frankly, that we haven't seen the baseline forecast move up actually suggests that it might have legs, because if economists' models remain unadjusted, if they remain pessimistic, but the incoming data flow has turned out better, until those models are adjusted, it probably has room to continue to turn out better. Because again, this is a relative comparison. So it's not even that data necessarily need to be strong. It's that it needs to be stronger than expected. And until these expectations move and economists start to get a little bit more positive in their assessment, these positive surprises might continue. So seemingly an encouraging sign there as well. Let's keep going. This is a sense of global economic activity, and the hardest part of that economic activity, the part that ostensibly has been so curtailed by supply chain disruptions amid uneven reopenings from COVID, namely, of course, in China. What we're seeing here is that the volume of global trade has been absolutely surging since about the middle of 2020. That, of course, makes perfect sense. We've had a tremendous amount of uplift in fiscal stimulus, so a lot more spending coming into the system, and a lot of that spending, while people are locked out, going to goods rather than, let's say, restaurant meals. So what we're seeing here then is an absolute surge in the volume of global trade. We can see that this has been inflationary, of course. If we take global inflation here, global CPI, and we lag it 8 months because, of course, first the economic activity has to occur, and then it'll have a knock-on effect on CPI levels. If we pull it back 8 months to get a sense of the trend, we can see inflation is starting to come off. It's early yet. We've come off from about 10% in the direction of 8. So still early days in this disinflation cycle, and certainly quite a ways away from where we were before COVID in the kind of 2.5% area. Let's call it an average of 2.5 to 3 globally. Obviously, if we look at developed markets, it was much lower. If you look at emerging markets, it was a bit higher, but clearly still well above the pre-COVID baseline. But the thing to take away here is global trade volumes have not collapsed. They seem to have stopped growing quite as vigorously. They seem to have paused a bit on their way higher, but we're certainly not seeing a collapse in global commerce against the backdrop of the disinflation that has been achieved so far. So, as it seems, again, so far so good. The optimists have it for the moment. Let's keep going. This is a look at the OFR, that's the Office of Financial Research within the U.S. government. Here you have their financial stress index, which is made up of over 30 various market indicators measuring financial stress. Again, internationally, this is the global index. You can see that as the tightening begins in mid-2021, not surprisingly, financial stress starts rising. Overlaid with that, you see the 12-month implied rate in Fed funds futures. So essentially, where the markets think the Fed funds rate will be in 12 months. You can see that both of these things peak out at the same time, right around the beginning of the third quarter of last year. So where the Fed is thought to have finally kind of signaled, we see the end of the rate hike cycle, and the markets reckoned with that idea and baked it in. And so, of course, now we're debating, are we going to have a terminal rate above 5, near 5? Some folks are saying 6, which is a lot, and certainly not anything that's baked into markets. But as we got this sense that, okay, mid-2023, these rates are going to peak, and they're probably not going to keep going thereafter, the 12-month outlook for Fed funds implied rate flattens, and financial stress begins to ease. And so now we're looking at the lowest readings on this financial stress index since the beginning of last year. That, of course, not a reversion back to before the tightening cycle. So financial conditions still shakier than they were, but clearly this is a very eye-catching reduction in financial stress. So if, like me, you've been concerned about the case for a credit crisis, it certainly doesn't appear to be showing up here, certainly not now. So is it then all clear? Does the stock rally then make perfect sense? Should we expect no recession, robust growth, and then sing kumbaya into the sunset? Is everything okay? Well, not so fast. And here, we're going to take a little bit of time because this is very, very important and maybe a little bit woolly. We've heard now repeatedly from the Fed, in their last policy statement, in pronouncements from various Fed officials, in the interview that Fed Chair Powell did with Bloomberg's David Rubenstein just this week, that monetary policy has lags, that we are just seeing the beginnings of disinflation, and that we are just starting to get to a restrictive enough level, and that we're not there yet on monetary policy to really have the kind of an effect that the Fed is looking for, that we are nowhere near the end of the game. And in fact, we're actually getting just the first bits done. And in that sense, it's very instructive to look at what happened with the last major tightening we had, which was back in 2004. So let's look at the dates here. And I've brought back that financial stress index here in a longer form version just to kind of get a sense for how jumpy do markets get around Fed tightening, and most importantly, when. So what you see here is the tightening cycle last go around begins on May of 2004, right around mid-month there, and runs through August of 2006. We don't see a bottom in the financial stress index, meaning financial conditions continue to loosen well after tightening begins. As a matter of fact, 10 months elapses before financial conditions really find some kind of a bottom and stop loosening. And this is well into the Fed's rate hike cycle, almost halfway in. The rate hike cycle doesn't end until August 2006. You can see financial stress has stopped deteriorating. We've started to sort of find a base on this financial stress index. So things have stopped getting better. Things have stopped getting calmer by the time the rate hike cycle is over. And then there is a kind of stasis, a kind of wait and see. And that wait and see lasts, again, for nearly a year. It isn't until May of 2007 that financial stress really starts to pick up, that there is a bottom in this index, and we start to see a build in financial concerns because the tightening has squeezed enough of the economy. And you can see that not till July of 2007, then, is there a move to go the other way. That's the end of the pause. So these are very long lags. Notice also that if you look at the current situation, again, we have the start of tightening, and conditions are actually improving. So the financial stress index is actually moving lower and is now below zero, which means conditions are less restrictive than average by a little bit. So we're in seemingly a situation not entirely disconnected from what we saw in 2004, where, again, the tightening cycle starts, but the financial stress index actually keeps going lower for almost another year before it even thinks about a turn. So these lags can be very substantial. Now, we did get a lot more tightening this go-round in a much more constricted period of time. So maybe these lags are shorter this time. Maybe it's not a 10-month lag. Maybe it's not even a 6-month lag. Who's to say? But clearly, these lags can be very, very long. And if you look at the intervening period from 2009 to about 2016 or so, you can see that the effective Fed funds rate is virtually flat at zero. That is the longest period in between easing and tightening cycles. So essentially, the longest period at whatever the low of the last easing cycle was in the modern financial era, which will date, let's say, to the mid to early 70s when the U.S. went off the gold standard and currencies became floating, and thereby credit expansion and monetary expansion essentially lost its ceiling and could go as large as the size of the global economy needed for it to go, because essentially it was based on fiat and not on being tied to a physical commodity. Not that this was something that stopped governments. Famously, of course, during World War II, gold convertibility was suspended because money was needed for the war effort, and there was not enough gold to back all of it. But that doesn't mean the war effort is going to be undermined. No, we'll just pause gold convertibility and print the money. That's generally what would happen in times of crises. In the early 70s, we basically said, you know what, this is a silly thing. Let's just let these currencies go. And that's ultimately what gives us the modern financial age we live in now. So since then and through now, this is the longest time we've spent at essentially zero rates, or whatever the low was for the preceding easing cycle. And in that time, accumulated upwards of $90 trillion in public and private sector debt internationally. That's the size of the global economy in 2019, before COVID, give or take, about 90 trillion. So when you look at that and you say, okay, well, what's the risk that in that span of time, at essentially no hurdle rate to investment, meaning anybody that wants capital for the most part can have it, with explosive debt growth, what's the probability that some of this capital was allocated not to where it needs to go? And that if you were to raise refinancing costs on that capital just a little bit, those bets, those investments, those businesses no longer make sense and are not able to make money. Unclear, of course, but the stage setting is worrying. And it is certainly the case that if we look at the situation as it stands right now, there it is, the markets do not care about this risk. It does appear to be that all these green shoots are there, and there is a real fundamental backing to what we're seeing in markets. There is a real basis for this optimism in real economic data, real economic conditions that make sense. But that's today. And we are not in a position, seemingly, if what we're looking at are 10-month lags before financial conditions even stop improving into a rate hike cycle. Never mind before they actually start to really feel the pinch. If that's where we are, and those are the kind of lags that we're talking about, it is much too early to sound the all clear, and a degree of caution and a degree of concern certainly still remains with where this tightening ultimately knocks something loose in the credit structure, still very much an open question. Obviously, crypto has been one. There has been weakness in tech where there's a particular sensitivity to credit cost. Lots of long duration assets in there, meaning assets that aren't that are linked to companies that aren't expected to make money in any kind of near-term sense. But clearly, if the evidence we're seeing now speaks to an economy that's resilient and credit risk that's contained, history would suggest it is much too early to extrapolate that in any kind of long-term way. And with that in mind, that's Macro Money. I am Ilya Spivak, head of global macro at tastylive. Thank you very much for joining us. Good luck out there. We'll see you on the show tomorrow. We're here every single day, Monday through Thursday, just after overtime, with our friend, head of futures and forex at tastylive, Chris Vecchio. Do come join us for that show as well. If you want to hear my various musings in between that and this and around the clock, that's on Twitter at Ilya Spivak. See you here back again very soon. Take care.